today we are excited to dive into how finance, accounting, and bookkeeping each play a vital role in the revenue cycle, and how understanding differences can help you improve efficiency and decision making. So we are thrilled to be joined by Iris Matanggihan. She's a seasoned finance professional, and she will walk us through real world insights that you can start applying right away. So without further ado, let's welcome Iris. Hey, Iris.
Hello, everyone. Good day. I'm pleased to be with you today to discuss finance fundamentals for smarter revenue cycle management. Okay. Each business type is unique. The healthcare industry is a unique industry, and so as accounting has its unique language that caters to any type of business. It is critical to bridge the gap as communication is the key in any client service provider engagement. So we have to ensure that financial communications are highly satisfactory and we address any misunderstandings and gray areas. Synapse would like to help its customers understand at least the basic concepts of accounting and finance so we can work together in building and growing the business. For the operations group in Synapse, we also need to emphasize the needs of our clients and how our efforts are aligned with the client's financial goals. Firstly, I'd like to share what we in Synapse Accounting Services team do for our clients. We will tackle key definitions of bookkeeping, accounting, and finance. Some people use this interchangeably, but I'd like to share some basic concepts and characteristics of these three different areas. We will come up with an understanding where bookkeepers, accountants, and finance analysts fit into the revenue cycle management ecosystem. We will identify types and components of the financial statements. And lastly, I'd like to share some general information and insights on automation. If you're a provider looking to improve revenue outcomes, reduce inefficiencies, and lead a more financially agile practice, this webinar gives you the foundational understanding to drive smarter and faster and more strategic decisions. For RCM leaders, if you're leading a billing operation, this session will sharpen your financial edge, equipping you to drive outcomes and not just transactions. At Synapse, we integrate accounting services directly into revenue cycle management operations. We don't just balance accounting books. We help you make smarter business decisions with real-time financial visibility. For billing and accounting, we do invoicing, customers, and reporting. We do bank reconciliations, credit cards, basic financial statement preparation. We assist on tax matters such as 1099 or unclaimed property reporting. For payroll, we verify data and inputs payroll into the payroll system. We also do reconciliation and audit processes each pay cycle. We also have controller services. It's on financial management reporting and analysis, and we also do calculation of key performance indicators. For CFO services, we develop our people's business acumen so we can also assist on financial matters. We do budgeting and forecasting, internal controls, consulting. This is to mitigate risk and prevent fraud. We do create accounting policies and procedures. We assist on cash flow and revenue management. We assist in the organization's strategic planning direction. And also, we assist clients in identifying tools and software suitable for their business. How do we help? For a group of healthcare companies, we handle payroll, we process vendor payments, we reconcile bank statements, and we prepare financials. We also document their processes to support scalability and control. For a smaller business, as a pulmonary and in sleep center, we set up their accounting system improve document workflows, maintain timely bookkeeping, and deliver accurate month and close financial statements. On a higher level financial strategy, we support automation like the pricing model tool, FTE review dashboards to help our clients scale without sacrificing accuracy or efficiency. This ensures your finance function grows with your business. Can anybody tell me what the accounting equation is? Or you can just type in the chat. With all the services that we provide to clients, I'd like to share the basics for a better understanding of the accounting and finance world. Assets equals liabilities plus capital or equity. Assets are the company's resources. It could be cash, tangible property such as land, building, or machinery. An intangible asset example is a software. Liabilities could be the company's obligations to its regular suppliers or a loan for purchase of a major equipment. Capital or owner's equity represents the owner's investment in the business. It is also called the net worth, which means assets minus liabilities. The double entry accounting system, debit and credit literally mean left and right. However, in the accounting equation, there's a functional meaning. When we say credit to revenue, it increases income. A credit to expense is a reduction. As a bookkeeper, it is important to understand the double entry system, which simply means every debit has a corresponding credit. This system is used to maintain the balance of financial records. An example is an asset purchase from a vendor under a 30-day credit term. While the debit recognizes the asset purchase like machinery, there's a corresponding credit to recognize liability to the vendor. After the credit term upon payment, a debit to accounts payable extinguishes the liability while there is a corresponding credit to cash. In the revenue cycle management world, when we recognize the service to the customer as revenue, we debit accounts receivable and then credit revenue. Upon collection, we debit cash and then that closes the accounts receivable to credit. Let's now define bookkeeping, accounting, and finance. Bookkeeping is more of routinary encoding. It involves gathering and organizing documents as basis for recording transactions. A bookkeeper is trained to use the accounting software, whilst an accountant trains a bookkeeper, develops himself as an expert on preparation of financial statements and tax returns. He does audits. With completeness, he ensures all transactions are recorded. With existence, he ensures that each recorded transaction actually happened. He is the main point of contact of stakeholders, owners, employees, vendors, customers, even banks and tax authorities. Lastly, the finance analyst focuses on the interest of the owners. He helps in managing the assets and liabilities, planning for future growth, budgeting and forecasting, and he does financial models and reporting dashboards. A bookkeeper focuses on historical records. He needs to ensure accuracy. An accountant ensures compliance with generally accepted accounting principles and international financial reporting standards. He is more involved in assessing risk, identifying internal controls, such as proper segregation of duties and collection strategies. A finance analyst is more forward-looking. He sees how historical transactions would impact the company's performance and financial position. In revenue cycle management, the bookkeeper creates and releases the invoices. The accountant reviews contracts and ensures accuracy of invoices, analyzes aging of receivables. He escalates collection issues and ensures efficiency in cash inflows. The finance analyst reviews pricing and conducts revenue analysis to ensure alignment with the company's goals. Any questions? Okay, so we now go to the types of financial statements. Can anyone share any financial statement? Okay, we have this types of the profit and loss statement, the balance sheet, the statement of cash flows, statement of changes in equity, notes to financial statements. Let's differentiate first cash basis versus accrual accounting in terms of presenting the financial statements. Cash basis means income is recognized when cash is received. Expense is recorded when it is paid. In accrual basis, income is recognized when earned. Expense is recognized when incurred. Cash basis is simple and straightforward. It is often used by smaller businesses and sole proprietorships. Although, on the other hand, accrual, though it's more complex, it provides a more accurate picture of the financial position as it ensures proper matching of revenues and expenses on each month of operations. Profit and loss statement summarizes financial performance and profitability for a specific period. So we have there the revenues or gross income, the cost of services or sales. These are costs directly related to generating the company's revenues, such as manpower or materials. Operating expenses or overhead to support the business. This could be office expenses, advertising, and other expenses indirectly related to operations. The balance sheet shows the financial position, which accounts accumulate all transactions since the start of operations. It is critical that all accounts in the balance sheet are 100% reconciled, meaning each account has accurate breakdown. The statement of changes in equity shows the owner's interest in the business. Capital consists of, the interest placed by the owners or the stockholders. Retained earnings is an accumulation of net income year on year, which is the source of dividends to be distributed to the owners, subject to availability of cash. The statement of cash flows, it's the inflows and outflows during a month or a year. There are three sections: the cash provided or used in operating activities, investing activities such as property acquisition and investments, finance activities, stock issuance to generate more capital, borrowing from banks or third parties, and dividends. What are the tools in finance and accounting? For small enterprises, we use QuickBooks. There's a similar software we have that we use, Xero. For large companies, we use NetSuite. It is, I think it's customizable. We also use Oracle. There are different versions of it. And of course, the SAP or the systems, applications, and products. Of course, we have the Microsoft Excel for data manipulation, for analysis and reporting. We have procure-to-pay systems. P2P is an end-to-end process of managing the cycle of acquiring goods or services from a vendor. It starts from requisition, sourcing, issuance of PO, delivery, and payment. Order to cash, or what we call the revenue cycle management. It's an end-to-end process of receiving orders from customers, managing fulfillment of orders or contracts, billing, and collection. Customer satisfaction is the key goal of O2C system while ensuring that all revenues are converted to cash. If you've heard of Zoho, it is a unique and powerful software for businesses of all sizes. It caters to end-to-end business processes. With Microsoft, it's not only used for arithmetic operations. We use formulas. VLOOKUP is used to match data among tables. We have also the E-formula that is used to return values based on a condition, if it's true or false. In advanced Excel, we could also do nesting or combination of formulas for more sophisticated results. Pivot table is also a very helpful tool. We can filter, sort, and calculate. For advanced Excel users, they use Visual Basic Macro Programming. It automates tasks within Microsoft application, not just Excel, but also Microsoft Word and Microsoft Access. It streamlines repetitive actions and automates sequences of commands. Database management is a key foundation in any revenue cycle management efforts. For medical and dental billing, we use PMS for managing patient demographics, scheduling appointments, patient registration, and tracking financial transactions to initiate the billing cycle. We also use electronic health and medical record systems, which store data regarding patient visits, diagnosis, and treatments. These are clinical documentations necessary for accurate billing to patients. We also have other softwares for contract management, accounts receivable or collection software, um, patient engagement platforms, insurance claims tools, and also business intelligence and analytics dashboards for reporting. So this is my last slide. I think I'm open for questions.
Thanks, Iris. All right, this time we are going to open this time for Q&A. You can type it in the chat box, or if you want, you can also unmute your mic, and I'll read the questions. Okay, we have here a question from Donna. In your experience, where do you see the most common misalignments between operational and financial reporting, and how do you recommend bridging those gaps?
Gaps often arise from timing differences, siloed teams, and varied KPI definitions. I think the solution is to align on shared metrics, automate reconciliation, and hold regular cost functional reviews. The common gaps are timing mismatches. Operations report PT based on service dates, while finance often records on cash or accrual timing. This causes the differences. There are different KPI definitions. Teams may define metrics like AR aging differently, leading to misaligned totals and expectations. Role silos. Separate ownership of data, billing, collections, accounting creates duplication and coherent reporting. So for us to bridge the gaps, we have to establish shared KPI definitions and a unified data dictionary. Hold cross-functional reviews bi-weekly or monthly to align timelines and reconcile discrepancies. We can use automated reconciliation tools to map line-level operational data into financial systems, ensuring consistency.
Thanks, Iris. Iris, could you maybe stop sharing for a bit? I think just to help out your net, just so it doesn't just so you're not cutting in and out. We can still hear you, but I'll have you stop sharing your screen. All right, there you go. All right, we have a question from Pam. What are the challenges healthcare clients face when it comes to aligning RCM metrics with financial forecasting? And how can finance teams be better positioned to help?
First is activity analysis. There's a need to track activities and identifies risk and challenges to mitigate and ensure customer satisfaction. Second is data manipulation and tracking. We have to ensure maintenance of a client database because it is labor intensive actually. So it is recommended to always think about how to do things better the next time. Visibility and reporting on incidents impacting client operations and financial errors. There should always be root cause analysis reporting. This is to identify corrective and preventive actions.
All right. Thanks, Iris. Okay, next question. Any practical advice on implementing automation without overspending? We are a small practice with a tight budget, and we want to streamline our processes.
When it comes to automation, the key is to start small and strategic. First, you have to focus on high volume repetitive tasks like eligibility checks, payment posting, denial categorization. This offer the fastest ROI or return on investment. Avoid over customization in the early phase. Use what the tool offers out of the box and just adjust only if there's a clear need. Leverage on what you already have. Many EHR and billing systems have built-in automation features that go unused. Involve end users early so you don't invest in tools that don't match real workflows. Of course, you have to measure impact early. Track time save, error reduction, and cash flow improvement so you can justify further investment.
Right, next question. Looking ahead, where do you see the greatest opportunity for automation across finance and RCM collaboration in the next 12 to 24 months?
Opportunity. Of course, automate reconciliation, denial analytics, and cash flow forecasting to streamline workflows and support strategic planning. Smart reconciliation automation. Automatically match AR ledger entries to billing system outputs to reduce manual effort. We have AI-driven denial analytics, automatically flag high-impact denial clusters in RCM, and route insights to finance for cost correction. Predictive cash flow tools, integrate billing data and historical collections to forecast cash inflows by account or client. This is ideal for planning, financial planning, and liquidity management.
Okay, we have another question. How do you recommend reconciling clinical productivity data with financial reports? We want to bridge our front-end operation and back-end finance.
Sorry, can you repeat
You
the
want me
question,
to read that?
please?
Sure. How do you recommend reconciling clinical productivity data with financial reports? And then it says, we want to bridge our front-end operation and back-end finance.
Back-end operation and I think let me think about. I think we have to monitor the accounts. I mean, if we are to reconcile, we have to make sure that we have all the processes documented, and so that everyone in the organization can follow the process and make sure that any gaps are addressed.
Right?
Does that answer?
I think this answers it. Let us know, Warren, if that answers the question. Okay, while we wait, any other questions for Iris? Going once. And there's a thumbs up from Warren going twice. Okay, I guess that got a shout out. Hi, Neon. That's from my invite list. Hi, thanks for hopping in. All right, I guess that's it. We have no other questions. Again, thank you so much for attending our webinar. We have that box over there if you have other topics that you'd like us to discuss. We will be doing this for the rest of the year. We'll be running webinars such as these every month. So stay tuned, and we will send you a copy of the recordings and the handouts a few days after this session. So if nothing else, thank you guys so much, and have a good rest of your day or evening. Thank you, Iris.
Thank you. Bye-bye.
Bye, everyone.